Last week, we got our first new trade deal from the Trump administration with the United Kingdom, the UK. This is an interesting one for a few reasons. On the one hand, the UK would seem to have the model trade relationship with the US. We ship more to the UK than the UK ships to the US, at least according to US government statistics. That would seem to be what the Trump administration wants. And at the same time, there is still a 10% baseline tariff on UK goods. There's a lot still to be worked out, but this leaves tariffs at a higher rate than they were before all of this started, as the UK's central bank governor put it. That gives us a model to think about the trade deals that are going to be coming in the months ahead. There's going to be a lot of noise, hype, fury about all the new trade deals that the Trump administration is going to sign before the end of its 90-day reciprocal tariff pause, which is July 9th is the end date for that. But if tariffs are going to be at least 10%, let's say as a baseline, that's going to have a real impact on the economy and on the market. In this video, I'd like to talk about 5 sectors or industries as examples of how tariffs might affect them and what investors should be watching out for. Because while this is going to have a big global effect, it also may create a lot of interesting, surprising, contradictory opportunities as we get down to the micro level, which is what a stock picker should be looking for. Let's start with a sector or an industry that I am very fond of, the travel sector. Travel is not directly impacted by any of this. We're not actually tariffing services, which is what travel generally consists of. At the same time, there are a couple obvious indirect effects. One is that a lot of foreigners have been turned off from a lot of the Trump administration behavior and the tariffs in specific, and so travel to the US has already decreased quite a bit, as we've been aware of. But companies, as they're reporting earnings, are making changes. Expedia lowered their guidance for revenue for this year by about 3% when you control for currency on their last earnings call. The airlines have been pulling guidance in American Airlines' case and preparing recessionary guidance in United Airlines' case. On the other side, Mexican airport operators saw growth of up to 18% in April for passengers. Pretty good sign of how travel is shifting. Global companies like Booking Holdings, which has as big a European business as anything else, have said, we'll do well either way, but yeah, we're adjusting and travel flows are definitely shifting. The indirect effect is going to be on travel for companies focused on the US, and it's something to watch out for. But also, if we have a recession, people have less money to spend, presumably travel is going to be hit. TripAdvisor CEO made the argument that actually people are now defending their travel spend more, which is something I think is true. I think that we value travel more. It's a reason I invest more in that industry, especially since the pandemic. At the same time, there's only so much defense can do if people don't have the money to spend to go out to travel. So that's something to watch for. Our second sector is semiconductors. Semiconductors are one of the most valuable pieces of the modern economy, and they are generally produced in an international global supply chain, a very intricate supply chain, as we saw during the pandemic when, because of the different reopening policies, there was a huge backlog in all of this, and it really was a big driver in inflation that we saw over that period. So to be playing with this, with tariffs to these different countries that are in the supply chain for semiconductors seems dangerous. At the same time, while the effect here should be pretty direct, there are some contradicting tailwinds here because there's also competition around all of this. The Biden administration, for example, was about to impose a law to restrict the export of certain chips imported for artificial intelligence. It sounds like the Trump administration is going to be rolling back those restrictions, which we can debate the politics, but there may be opportunities for chips to see fewer restrictions in some areas. At the same time, China is a huge piece of this puzzle. China and the US are having trade talks as I record this video, and that'll have a lot to do with how the semiconductor is impacted. The direct impact here could be pretty big, depending on how things shake out. And the indirect effect, of course, if there's a recession, this is a cyclical industry that will affect things as well. Another industry that's an industrial and so theoretically is cyclical is aerospace. And aerospace is interesting because Boeing is one of the US's biggest exporters. So in theory, they're on the hook for any backlash tariffs. If we have an escalating tariff war, aerospace is one of the first places to hit the US on. At the same time, there's an ironic insulation that companies like Boeing and Airbus, the duopoly in major commercial airlines or airplanes, have, which is that they've struggled for so long to produce planes at a sufficient rate that they may actually not have to worry about tariffs so much. What do I mean? First of all, on the direct impact, Boeing is big enough that it can offset the costs, and it sources enough stuff in the US, Canada, or Mexico where tariffs are not as big an impact. At the same time, China is not accepting delivery on Boeing planes. That should affect Boeing, but because there's such a backlog, they can just sell those planes to other customers who have been waiting for a long time to get their planes. It may lead to Boeing burning up its backlog a little bit quicker, but it's a backlog that some people estimate extends into the 2030s to really catch up to demand. That gives them a lot of insulation, even in a recessionary indirect effect environment, because with a recession, still, people need to be planning their airplane buying for longer term than 1, 2, 3 years. That means that Boeing and aerospace suppliers, as a result, are in a relatively decent position with all of these tariffs, as far as I can see it. Retail would seem to be one of the most obvious directly impacted sectors in the market, and retail ETFs are still below Liberation Day levels, unlike a lot of other sectors. They buy things from vendors, these retail companies, for a price X, and they sell it to customers for a price Y, which is higher. If you add something on top of X, a tariff, either you're cutting the difference between Y and X, which cuts their profits, or Y has to go up. You can think of this as the 2 Barbie dolls versus 30 Barbie dolls problem, as our president so eloquently described it. At the same time, there's still a lot of unknowns. We don't know what the tariffs are going to be on some of the countries that were set up as alternatives to China for importers. Your Bangladesh's, your Vietnams, countries that in theory want to be part of the US orbit, but are still getting hit with tariffs. If deals prove to be more attractive there than they were in the UK's case, maybe this lessens the impact. Retailers can vary their flows, vary their sourcing. Maybe that mitigates some of the tariff impact. And maybe American consumers just want to buy the things they want to buy and aren't worried about the extra price. This would seem to be contradicted by the inflationary period that we just went through, which led to the election result in a large extent. So retail, it's going to be probably ground zero for what's going on here and will be interesting to watch. We get a lot of data in the next couple of weeks. Walmart reports earnings this week. Target, Home Depot, and Lowe's report next week. And Costco reports at the end of May. Those are 5 major US-based retailers. We'll get a lot more info in that time. The last sector I wanted to talk about is finance, because finance is always interesting to think about in this context. On your first level thinking, well, they're not tariffing services. They're not tariffing money. In theory, finance is insulated from all this. It isn't affected. But then your immediate second level thinking is, well, but financial companies are investing in companies that are affected by tariffs, or lending money to companies that might be affected by tariffs, or directly depending on economic flows, on how the economy develops, whether we hit recession, whether we hit inflation, whether we hit the dreaded stagflation. Finance companies are in the middle of this. They're insuring products and goods that are now getting more expensive to repair, as in auto insurers. Finance companies are pretty dead center for this, for indirect effects. As the economy goes, finance companies tend to go, and though they're in stronger position than they were in 2008, of course, but in other past periods, this is going to be a tricky period for financial companies, and they are a good indicator for what market sentiment is. As finance companies are going up or down, we can see how the market is pricing in the risk of recession, inflation, Federal Reserve moves, and other things. Again, tariffs is going to be something that we're thinking about, feeling the effects of, and talking about for the months and maybe years ahead. And it's worth not just sitting on the market level, but also getting down into these company sector level effects. Those are 5 sectors or industries that I think are interesting to cover for this week's Stock Market 5. My name is Daniel. You can subscribe to this channel for more of these videos. You can check out middlecoastinvesting.com for my registered investment advisory business, or you can check out shortinvestingguide.com, where I have a lot more videos and articles about how to get started as an investor in the market. Thank you for watching, and stay tuned for next week's Stock Market Think Go.